Hey Naimul.
Hi, Emmet. Finally, the introduction went longer than the
It
plan,
was it
but
was it was very helpful. It was very good.
no, brilliant. Thank you so much for being here, and thank you to
Pleasure.
and thanks also to J12 Ventures for being here. So I think let's start at the beginning and dive right into this. Tell us about yourself. Tell the community about yourself. You can start anywhere you want, like as
All
far
right.
as in the past you want to go, or however you want to go. That's
Okay.
usually an open question.
All right. I won't go too far back, but yeah, I'm originally from the UK, kind of an hour southwest from London in the countryside. Lived there until 9 years ago when I moved to Stockholm. So unlike I think most people that come here from abroad, I have no one to blame for the move. It was of my own accord. So I came here to study at the Stockholm School of Economics. And it was there that I met the two guys with whom kind of been working since then. So Alex and Luca, two of the other partners in J12. Now we started working together, during that time while we were studying, a brief period of doing some consulting projects before we co-founded a fintech company called Novo in the personal pension saving space. And at pretty much the same time, then we co-founded an angel investor network called DHS Venture Partners, doing very early stage in investing here in Sweden. So for a few years, we were working on both sides of the table, which was a great opportunity. Before we put full focus on expanding out our investment activity. So we partnered up with Bull Mattsson, who's the fourth partner in the fund, founder of a number of successful companies, including Since, global leader for digital insights platform, and built kind of towards where J12 is today, where we're now kind of established as a pre-seed and seed stage fund based here in Stockholm, operating somewhat of a hybrid model as we see it, given that we continue to run and manage that angel network, the DHS that we'd originally founded. So we have this kind of two sides to the way that we work. One, very much as a fund, investing half a pre-seed, I would say half at seeds, with investment amounts ranging from kind of 100,000 euros to close to 2 million euros. And in those very early opportunities, partnering very heavily with the angel investor group. So looking at opportunities together with them, benefiting from the fact that individuals who have long careers within certain sectors, business model types, technology areas, have specialized expertise to really complement the, I guess you can say, generalist approach that a fund may have. So we're often co-investing with that group, and certainly looking at a lot of opportunities together with them. So that's kind of, from not too far back, a bit the path towards where we find ourselves here.
Very good. I think I'll have a couple of questions popping up already over
Please.
there. But let's start with, how is the feeling? Like, you have gone through a couple of transitions there. Like, there has been an entrepreneurship background, and then
Mm.
angel network that you founded, and then the VC fund itself. How is the
Mm.
experience similar or different in these three roles?
I guess, I mean, some of the similarities, even in establishing the fund, it's in a way similar to starting a startup in terms of the commitment, the risk appetite to get something off the ground, from nothing, um, and to create something from scratch. So there are similarities in that sense, and the way that we look to build forth this J12 platform going forward is in some ways reflective of the way that we approached that initial startup journey with Novo, and as I think a lot of people approach building companies. Obviously, the models are completely different. The transition from the angel investing activity towards the fund is obviously a lot closer than from the pure entrepreneurship side to the investing side. I guess what's very different is from a mindset perspective, when you're purely building your own company, your focus is very directed to one thing over a long time. Building out a fund, you have that long-term focus for what the fund should be, but the majority of focus is then split across, you know, a lot of new companies to meet, a lot of companies to work with at the same time. So it's a very different kind of mental exercise, I would say.
Okay. So there are similarities and differences. Let's dive into one other point. Your UK background. At that time, were you in entrepreneurship? Were you a part of ecosystem? Can you relate some differences or similarities between the UK and ecosystem here, or was it too early?
Sadly, I can't too much. I'd studied in the UK, and then I moved here for further studies. And I think, I mean, I had studied economics, and then I was studying finance. I think I was on a mental track to come to Stockholm and study a master in finance, and then return to London and get a rather dreary job in the city doing something. So I think to a large extent, the ecosystem in Stockholm and kind of the people that you get exposure to and seeing what was being built here was very much kind of the awakening from my part.
Okay. And then you mentioned something very interesting, like building a fund or raising a fund has close similarity to how you build a startup itself. And we had a few months ago Adio Risi here, who talked a lot about his building process of creating the next venture funds, like through VC Lab and everything. Do you think there is a lot of activity now going on in the market in our new funds coming in? How is the VC funding landscape right now out there?
I think definitely there is a number of new funds. Certainly, if you look back the last 2 years or so, there's a lot of kind of first-time funds that have entered the market. So the way the picture looks today is quite different to the way it looked just 2-3 years ago. Those funds are now raising second funds. I think there is also an inflow of new first-time funds as well. I think we see that those funds emerging. We hear that from the types of investors that would potentially be investing in those funds. They see a lot more opportunities to invest in first-time funds as well. So there's definitely capital pouring into the market and looking to establish at various stages, and also taking various niches from generalist to pure climate to pure deep tech, and these kind of things as well.
So from generalist is going into pockets like impact and more thesis focused funds.
I think you still have a lot of generalist funds, but there are a number of new funds that are launching themselves with a thesis from day one. I think you see that.
And when we talk about, is there a particular stage where you think this activity is or can become more pronounced in coming years? Like, is it the very early stage, seed, or like?
In terms of investment activity?
Yeah, in terms of investment activity, investment or capital being available to startups.
I think I still believe there is room for more capital in a seed stage or in a pre-series A stage. I think that's a stage where a number of funds have entered the market in recent years. But I think there is still room for more players or more differentiation amongst players there. I think what we see at various stages is also an increased globalization of investment activity. So particularly Series A and above, there's more American VC activity in Europe. There's more European fund activity across Europe. Partly driven by COVID and people being remote anyway. Partly driven by more ecosystems maturing across Europe and attracting capital from further afield. So I think those dynamics will also add capital or slightly change the way that investors behave, perhaps.
Okay, so that's a very interesting point that you talked about pandemic and all that. So in the VC sector itself, you think pandemic has been an enabler of reach out for startups?
I think it's whether it's enabled it or if it's just kind of lowered the barrier for people to do it. I think previously there was, more of a consensus that if you're going to be investing in a market, you should have a presence in that market and should either, somebody on the ground or be traveling there fairly frequently. So in, markets like the UK and the US, where much more strict lockdowns than we experienced in Sweden, even to invest in the local in the city that you're in, you have to be remote. So then to start connecting with and running full investment processes through to signing, a term sheet with a company in a city a few 1,000 kilometers away looks the same as to do it with one round the corner, because you can't see them anywhere. So I think that opened up people to be a little bit more geographically agnostic. And I think when things return to whatever state of new normal they do, there will be there's still an advantage to be where you're looking to invest and to be meeting people in person. But I think it has lowered people's thresholds. So I think people are now investing across wider areas, or funds are being more willing to work in a distributed fashion themselves than they probably did before.
Okay. So, but you think the digital connection still enables the trust to be established and due diligence to proceed as almost normal?
I'd like to think not, because I think it's nice to meet people, as nice as this is. But I mean, funds have been doing it for the last year and a half, 2 years, because there's been no choice. So maybe time will tell if those decisions can be looked back on as having missed something because the process was different. But no, I think you can. It's a very different thing if everybody has to work like that. But it changes if the world goes back to a state where half the funds that might be looking to invest in a company are meeting that company in person and building closer relationships, and you as a fund are looking to do that fully remotely. Then I think you will suffer a disadvantage in terms of winning, the opportunity to invest in the best companies. But when everybody is having to do those things remote, then it evens out, and I think it's manageable.
So there's no unfair advantage left. So it's more like a forced normal instead of the new normal. Okay, very interesting.
We'll see. We'll see how it develops.
We'll see. So while we are on the topic of geography, let's go. How would we do? Okay, let's go into your fund, and let's talk about geography. Is it like you're focusing on Sweden primarily? How do you define your geography?
Until now, we've been predominantly focused on Sweden. We have one investment in the Baltics. We are increasingly active across the wider Nordic Baltic area, and from this point forward, we'll more spread across the Nordic Baltics, and also more active in other markets such as UK and Germany to some extent as well. But I think it's fair to say that investing as early as we are, and given the thesis we have for how one needs to work with the teams we invest in, or to get access to the best opportunities, the vast majority of what we invest in for the next few years will remain Sweden Nordics. So that's kind of where our geographical focus is for now.
So Sweden Nordics, that's a good way to put it. And then what's your focus? Are you very broad when it comes to technologies, or what kind of companies you're actually looking at?
Yeah, broad is a better way of saying lack of focus. So we'll say broad. So I mean, we're pretty broad across all sectors, business model types. We have a similar amount of B2B companies as B2C in our portfolio. SaaS, enterprise software, consumer subscriptions, various marketplace models. We don't invest in any kind of real life sciences. We do less hardware investments, but if there's a strong kind of data software component with that hardware, then it's within kind of scope. So yeah, rather broad, and looking to not set too much of a framework that doesn't allow us to be pleasantly surprised by the edge cases that that always emerge.
And which stage of a team or a startup is something that you love to work with, or that your focus is? Focus is one thing, but where you think you can make the most, bring the most value to the team.
So yeah, as I said, I mean, where with about half of our investments are what we might call pre-seed, where it's kind of often pre-revenue, still in a bit of a product development phase to bring kind of a first MVP or so to market, and then half of our investments are slightly more mature seeds, where there's maybe 1 to 2 years of traction and momentum, but still finding the degrees of repeatability and predictability to raise a proper Series A expansion round. So that spectrum is where we invest, and that's a reflection of where we enjoy being and where we think we can provide value. I think if we narrow down, how we look to work with those companies or the value, I think what's important at that stage is a few things. Say finding product market fit, finding repeatability of sales, scaling team and organization, and fundraising. And I think if we look at those 4 things, the first, product market fit, we recognize there's the best people to talk to there are your customers. So speak to them rather than us, I would say, probably. Sales repeatability is key to go from that initial traction to start to show what a sales organization, process, channels looks like, because Series A is going to be based on repeatability of that sales process. So that's an area that we like to focus towards, and team similarly, to go from a few people to quickly scaling organization. If you can be marginally better in your recruiting of each position, and also in your ability to scale the culture, which one could maybe see as being the multiplier that makes all the sum of the individual parts add up to more than it is, then you'll also be very competitive. And then fundraising is obviously something that we're tapped into very much, all stages of funding, and the more we can work with companies to fuel themselves into the next stage and grow faster, then the better as well.
Okay. 2 questions coming from that. How often do you follow on?
So I mean, almost the majority, or a large part, about half of our fund is allocated towards follow-on investments, let's say. So we're geared towards following on. In most companies, we will at least take pro rata in following rounds. Obviously, an increased amount of that follow-on allocation gets steered towards companies that begin to look like the winners in a portfolio. So some companies we will fund for a longer part of their lifetime. Most we will fund at least kind of into the next round or so. And the kind of risk that we take might mean that some companies don't raise future rounds, I suppose.
Okay. Very interesting. My second question was based on something which came up in our previous talk with Joachim from Almi Invest. Because if I remember correctly, he mentioned that as a mandate, Almi Invest goes in with 50% or half, and then other half has to be raised out by private investing or other VCs or angels. Do you have something like that? Like, what's the round construction in your case generally when you are working with startups?
No, we have no fixed requirements in that regard. We lead more of the rounds that we invest in than not. We've co-led a few rounds. We've been a smaller part of a few rounds as well. So we're somewhat flexible, in that regard. If we would simplify and kind of bucket into 2 types of investments that we do. A number of what we, where we lead, invest, with great conviction and look to be the majority share of an investment round together with a selection of great co-investors. They might be other funds or angel investors. And then in other instances, maybe because of the structure of the round or how late we came to meet the company or whatever, we might be a smaller part of those rounds. So there's flexibility. I think the most important thing for us is to be working with what we perceive to be the best teams.
Got it. Before we move on to, because I have a couple of points listed out here generally on the funding or early stage. But before we go there, let's have one or two more things about J12 and how you work. One is like, how do you usually work with the startups that come in? Are you a very hands-on kind of a structure? You give a structure to the startups, or like what's the approach when you take on startups or kind of take them under your wings, for example?
Yeah, I guess the first just caveat would be it depends. It looks different in different cases, but ignoring that, then I mean, we don't look to apply too much of a structure in that sense. Our belief is that we are with conviction investing in great teams and trusting them to work in the ways that they need to be successful. But within that kind of belief, I think our role is to be an ever-present sounding board to those founders for all matters strategic, growth, recruitment, fundraising, whatever it's going to be. And in some cases, it makes most sense to kind of structure that ability to work together in more of a formal board setup where we'll often take a board seat. But that with ad hoc WhatsApping at whatever time in the night or the day. So there's constant flow of small communication and then maybe more structured strategic and board work. And then in other cases, if the company is very early, it doesn't necessarily make sense to formalize a board structure at that point. There are other ways to retain a working relationship and provide value. Or if we're a smaller part in the round as well, then the way that we work with those companies might be different. So I think that's generally the approach. We look to various people within our team that maybe have specialized experience as operators in company working with things like B2B sales or recruitment or whatever, are then brought in to support a company if they're going through a process or looking into that area. Then then whoever from our team is best suited will spend more time with them. But generally, there's one of us in the team that takes a close lead and works with those companies.
And generally, the structure, just continuing that point, is that then you divide the roles between the teams. So this team member would be working with, for example, B2B startups. This would be working with that. So you divide the portfolio based on the skill set of the team.
Yes and no. That happens to some extent. Otherwise, I think we see that the four of us partners work with a range of different companies, but then recognizing perhaps different competences on our side. Whoever is most closely working with that company might pull somebody else in for a specific session or at a moment in time where there's a particular question that the company is working through. So it's a mixture in that way.
Last question before we move to more general questions about the funding and how the startups should approach it in early stage. How about impact? Like in recent times, we are seeing specific funds coming in with impact positioning in the local market. I would not name, but very recently a large fund has been created specifically with a focus on impact. And impact, sustainability, the the environmental side of the sustainability as well as the social side of how the planet and the population kind of interacts with each other. How important is that becoming? Is that becoming a major decision factor? Do you think people in future will start opting for impact funds if they are creating an impact venture, or can an impact venture equally well fit into a fund which doesn't position itself as impact?
Mm. Um, I would like to believe so. I mean, for me, I think, you know, anything that is going to be truly impactful necessarily needs to be extremely scalable. And if that is the case, then it reflects what a typical non-impact VC case can look like. I think it's, you know, evidently there it's people behind decision making at any fund, and I think most people are keen to invest in great investment opportunities that are also positive impact. So
Okay.
it's more interesting and motivating, I guess, for people if that blend exists. But a non-impact fund will, you know, not substitute returns to pursue impact. But I think what we see increasingly is that, you know, even if you're purely returns driven, impact is a driver of great returns, because consumers are demanding, you know, more positively impactful products and services. Companies are positioning themselves in a more positive impact way because stakeholders demand it: employees, customers, shareholders. Governments are subsidizing and, you know, writing policy that moves things in a positive impact direction, and investors at all levels are allocating more to positive impact projects or companies. So purely from just looking like you would in any way at where market dynamics are moving and where preferences are heading, the rational thing is to see opportunity in companies that are inherently positive impacts in their business model. And I think increasingly we see that the two go together. It's not for me to know or to say if those funds that do brand themselves as purely positive impact, if they have a willingness to substitute returns for impact. I don't know, but I believe not, and in time, you know, hopefully the two won't be differentiated.
No, that's I think that's a brilliant answer that you gave there, and I think I'll just point out to our community as well that if you have an intent of making an impact, again, scale is important, because do you want to make impact at the scale that you are or here? Because then if you're making that leap, then that is interesting for external investors. So scalability is very important, and then what you said, that impact necessarily now also is a guarantee of driving the business health in different indicators. So if you are developing an impactful business, it will lead into business indicators. Let's switch to the other side. Let's start, and the audience can start putting their questions as well, either from the VC fund side, if there is, or if you are a startup and you have questions, however you want to structure those questions. So you can keep them coming on the chat. Let's talk about early stage. For example, I consult a lot at Coompanion. We consult a lot of very, very early stage companies, and one of the issues that we see is that what is an early stage? How do we define early stage in VC terms? For example, for you, what does early stage mean?
Yeah,
because a startup says that I'm coming here, I want to pitch to J12, and I'm an early stage startup. What is an early stage startup?
Yeah, no, it's true. I mean, all of these labels, early stage, seed, pre-seed, whatever, I mean, yeah, they often mean different things to different people. For me, for us, I think early stage is kind of the spectrum that I described earlier, where we're at kind of everything pre-series A. So in that, to then apply the two sub-labels, whatever they're worth, pre-seed and seeds. So companies that are, everywhere from building product and pre-launch through to traction and finding their paths to growth, but not yet at a stage where they've proven real repeatability of growth, and they're kind of in a, let's bring in this amount of money and we pretty much know that we can get out this amount of output and scale in that fashion. Then that would be moving towards more of a growth phase. There's a lot of blurred lines in between those two. But for me, that's early stage. And obviously there's a big difference between a company that has quite some sales but not yet repeatable, and a company that doesn't have a product yet. So yeah, one is a lot earlier than the other, but it's all kind of early in the grand scheme of things.
And maybe it varies between the models as well. If it's a deep tech versus a simple social platform, for example, these are very different companies depending on the tools that are available for them to be created.
Exactly. I mean, one type of company early on should be showing some traction because it's a lot quicker to market, and you have that, and maybe deep tech hardware, you'd be early stage for many years, still doing R&D and not yet commercializing anything. So yeah, again, there's a lot of caveats to a lot of answers. It kind of depends what kind of company you're building.
Okay, let me create a trappa, as we say, like steps, because you mentioned 3 very interesting points here, and I'm just trying to locate the notes here. You said pre-repeat sales, that's one thing that you talked about, repeatability. So the point before repeatability, when that is strongly established. You also talked about traction and product. Generally, when we're talking about, so VCs in their thesis can also say that we work with Series A or later, or we work with early stage, or we work with pre-seed stage. So imagine and generally we are talking about the VC industry right now. So if a VC labels itself as early stage, and if the startup, so what do you think an early stage fit would be for them? Can a company, so definitely, as you said, pre-repeatability is something, but can you be pre-product and be there pitching to VCs, or you should just take VCs out of your equation and do something else, or raise money somewhere else?
We've invested in a number of pre-product companies, and other funds have been doing even later stage funds. I mean, we're one of the earliest funds active here. Even later stage funds that are often at Series A have done in the last couple of years the occasional kind of pre-product, or at least pre-launched product.
Pre-launched product,
investment. So I mean, we've done both, kind of investing in something that doesn't exist at all, as well as investing in companies that are kind of midway through developing first version of the product. I'd say what maybe differentiates those cases, I guess, the more conviction that you have that the team is great, has unique insights into the market that they're addressing, can execute really well, and the more conviction that you have that it's a really big, timely, exciting market to be addressing, the more willing you might be to invest before there's a product that exists, because you have 2 factors that are very strong, and there's a risk appetite to invest in that great team to build some product that will address that great market. If you have a case there where you would like to see a little bit more evidence that the team can execute, then you might want to see product and a bit of traction to kind of educate them on their execution, educate yourself on their execution power. Or if there's a market that is maybe, I don't know, already has some competition, or is less clear to you as an investor in terms of the size or the dynamics and the absolute opportunity, so the market conviction is a bit lower, then again the willingness to invest earlier might be less, and the needs to see some kind of fit with the market might be more. But definitely I think funds are willing to invest in those early product, pre-product companies, and it's often it's often also in slightly deeper tech or more product risk heavy kind of companies, where you need to fuel a longer path of product development. Then again, as we said before, if you have a more simple, maybe consumer facing solution, there might be an expectation that you should be able to get to launch prior to VC funding. If you're building an advanced data platform, then VC funding will be attracted to a great team looking to build a product in that space.
Excellent. I think very interesting point for our community. So we talked about pre-product or pre-launch product, and Emmet was discussing the crucial element in such cases would be team, or since the product in this case doesn't have market metrics in place, some sort of market opportunity sizing, or the faith that this team can actually deliver the results. So delivery, potential delivery, and the team. Going into the team, what do you think is very important for a startup in such a case? Like, what are the red flags, or how should we put it? Like, what will build more faith on the team at such a stage for you?
Yeah. I mean, I guess there's a combination of kind of hard factors and soft factors. So the first being kind of looking at, founder product fit, founder market fit, how well suited is the founding team towards building that kind of product or addressing that market. We often talk about, teams that we perceive to have real unique insights into the space that they're addressing. So those are important. That doesn't necessarily need to mean that a founding team comes from the space that they're addressing.
Okay.
I think often it's very much the opposite. The value of coming from the space you're addressing surely differs depending what space it is. But then next to those kind of skills on product and market fit with the team, I guess there are some characteristics that one likes to see in an investable team, and especially early on, teams need to have some kind of magic balance between being extremely stubborn in what they're doing and understanding that, if you're going to do something that no one's ever done before, a lot of people are going to tell you it can't be done, and it's going to be difficult, and you're going to have to be a little bit pig-headed to plow through with it. But at the same time, need to have the, openness and ability to pivot at the right time and take in information from customers, from advisors, from the market, even from investors, and be flexible in that way. So kind of a strong opinions, loosely held approach is needed, and that's a fine balance to have, alongside an eternal amount of grit, an ability to attract people to what you're doing. Great teams need to be able to attract great talent. They need to be able to attract vast amounts of funding. They need to be able to attract customers or users. So all of those pull factors need to be sensed when kind of getting to know a team pre-investment as well.
Okay. Very interesting insight there. And one point we can take deeper into while we are on the topic of teams. Is it completely are VCs completely out of bounds for solo entrepreneurs which have not yet built teams? Because in a previous session, I remember a few months ago, we had somebody who was an ecosystem specialist. He talked about this triangle that you need to have a evangelist of the idea, somebody who is a customer champion, then a tech hero, and then this triangle is complete, and then you're ready. Is that so? Yeah. Is that a myth? Yeah. Or can you...
I mean, all frameworks, they hit something, but most lies outside it. I think, often it's talked about, solo founders and the risks associated there. The way I see it, everything, whether it's related to team or product or whatever, is something to be understood, and it has to be understood in relation to all other factors that are within the context of the opportunity. So obviously we've invested in solo founders. If it is a solo founder, that probably puts a lot more requirements on that person to be incredible across a more range of things than if there are two founders, and you can split that ability. Or in terms of finding this founder market fit and founder product fit, that's going to rest more solely on one person. I think great companies have been built by great solo founders who drive things forward and attract strong teams around them. And I think a lot of founding teams where there are three people have soon become two people, and suffered as a result of that, within 6 to 12 months of getting off the ground. So both come with risks, because a solo founder has to carry a stronger burden. A broader founder team is at more risk of breaking up and having to manage that kind of process. So I think everything is just, if there's a team of 2, 3, 4 founders, you want to understand the dynamics within them. If there's a solo founder, you want to really understand that they can attract fantastic C-level around them going forward. So I think it's just a different lens to look at things in. But at least for us, nothing like that represents a red flag. It represents something to understand.
That's great to hear, and maybe this is really good. So all solo founders, if there are solo founders on the call, good news, it's possible. So the door is not closed for solo founders. Okay, but a lot more responsibility, because then you need to drive and take the story around and get the C-levels, as Emmet was saying.
Exactly. I mean, if you're a commercial CEO, you're going to need a strong tech lead or co-founder to join you at some point. So those are some of the conversations that we'd have.
Got it. We are close to taking the questions. So Vinod, maybe you can structure them up. I had 1 or 2 more points if I'm going back on the page. Let's take a quick discussion on traction in VC terms. Because traction is very broad, and it generally is applied to, you need to have more traction, and then come back to what is traction. Like, what are 1 or 2 sub metrics that you at J12 or generally you can talk about in the VC industry? What do we mean by traction at early stage?
Yeah. I mean, I don't think anyone knows exactly what level they want to see of traction. When they say come back with more traction, there's not a clear level that this is the level that's gonna nail it. I think often that's an easy way for funds to kick a real answer down the line. It's again, depending on what you're building, the level of traction needs to be different. So if you're B2B, how many customers, what kind of recurring revenues, it's going to look different depending again on what kind of market you're addressing, depending on the velocity of the growth of that revenue, because it's both a volume and velocity kind of equation. People might be more willing to invest in earlier revenue if they perceive the market opportunity to be open and great and to be chased. On the consumer side, similarly, it's a combination of number of users and the kind of engagement or the kind of retention that you're able to show, willingness to pay, active usage. It very much depends on what kind of product you have, what your business model relies on is going to drive different metrics. But again, I think Series A investors often talk about a magic metric of $1 million kind of euro revenue to be of a size of some kind of relevance and growing like 3+ times per year, kind of last 12 months or so, at that kind of slightly more later repeatability kind of stage. So I guess traction at a seed stage, kind of building towards that, is needs to be some kind of combination of volume and velocity trending in that direction.
So volume.
But again, when I hear that 1 million euro kind of magic number, it's if you look at the revenues of all kind of Series A companies. You'll get everything from 0 revenue to
Exactly.
I don't know,
exactly.
10 million euro revenue. So yeah, it's nice to be able to give a magic number, but the truth can look extremely different depending on what you're doing. Which is an unhelpful answer, I understand.
No, but it's good because it puts pressure on startup CEOs as well, or the founders as well, as to how they are presenting their startup. So if they know their market, they know the opportunity, they know they can do it. Of course, they can present the traction, or the way they see the outlay, let's say, in the next 12 months to 18 months or 24 months. So I think that's very important, that you yourself as a CEO or a founder know what's happening ahead of you. So that'll determine. And I think that goes back to your point of team being very crucial, and the faith of non-established market metrics. If you can bring them to table, I think that'll be good. Vinod, if we have questions, let's bring them on. You can come into the conversation, and while we are at it, maybe Emmet, we can discuss what's the best way for our audience or the larger community. This talk will also be on Startup Grind Global community, for them to reach out to J12. Like, what's the best way to go ahead and get your attention?
No, it's a good question. I think it's always valuable to manage to find mutual connections and referrals. It establishes a good ground for beginning to develop a relationship, and it's a good way for founders also to begin to understand who we are as well. But if people reach out to us directly via email, then we look at all of those opportunities, of course, and then go from there to take meetings and try to understand things further.
But do you think that's also generally the case with VCs, that when startups are approaching going into fundraising, is it good to network around and kind of find your way onto an investment discussion through common sources? Or would cold calling still work? Yeah,
I think there are a number of funds who probably don't look too much through cold approaches. I think certainly if a trusted person refers an opportunity to you, you are more likely to prioritize that, because it has some validation. You have some responsibility to that trusted source to provide some feedback to them perhaps as well. So there is an advantage to that. It will create more urgency on the investor side, and it will create an initial baseline that is a bit higher than a cold approach. But I think otherwise, generally in approaching investors, I think founders should look at it in a similar way to how they look at product development and the way that you speak to customers. I think a lot of the time founders will wait until fundraising to then reach out to funds in somewhat of a cold manner. And that's analogous to if you would build product for like a year and then think, okay, now I'm going to sell and launch, and then that's the first time you show it to customers, and then inevitably you don't know fully what the or if you're a good fit with the customer, and you're going to have to work for 6 months more to kind of begin to understand that better. So of course you speak to customers in the process. You're not selling from day one, you're understanding and you're building relationships so that when you're at the point of selling, you have a better fit. It's exactly the same with investors, that I think building early relationships, not to sell or to pitch, but to discuss what you're doing, to share what you're doing, to give people the opportunity to eventually invest in a line that they've observed over time rather than a dot that they see at one moment, is going to be in your benefit, and it's going to lead to a faster process with those investors as well. So like anything, it's better not to be selling. It's better not to squeeze it into a narrow window.
Got it.
And the more you can build relationships with people, the more you will also vet if those are people that you want to potentially work with for the next 10 years, because it's a long marriage.
Excellent point. Long marriage. Vinod, thank you so much for being here. Vinod is strategic initiatives lead at Startup Grind. He'll be taking us through Q&A. Emmet, I had one question. We kind of got dragged in that main conversation. Would you have 3, 4, 5 minutes over the top after one if the questions take long? Okay.
Yeah.
Okay, brilliant. Vinod, over to you.
Perfect. Emmet, thank you for that. That was very insightful. And I think you fit into that sweet spot, because usually early stage startups say, you know what, we can't have a conversation with VCs. But as you articulated, I think you kind of fill in that space very well. Fortunately for me, you've answered quite a bit of the questions that came in, mostly around geographies that you operate in, your definition of pre-seed, what you're expecting from a team, and so forth. So we can comfortably skip those. There are some, for instance, and I'm going to club a few questions here. So do you take a first meeting in person in real life? And how do you evaluate a pre-seed startup? What are the common reasons you would look at to invest in them, not invest in them?
So yeah, preferably I think it's better to meet in person, but we do both depending on what works. Common reasons not to invest, or what we look to invest in pre-seed, as kind of said, I think it's at that point it's so early with regards to both product and market fit and those things. So predominantly we're looking for founding teams that really fit the market and product that they're addressing, that we perceive have unique insights into what they're doing. And we're most excited in opportunities that we see to be representing the creation of whole new markets, or really being part of driving a shift in a large existing market. So at pre-seed, it's often understanding those two areas more than anything else, to see that there is a scale of opportunity, potential to be a global category leader, and possibly a team that can begin to try to pull that off. And that's a little bit the mix prior to having too much to see in terms of product market fit and traction at pre-seed. So I guess to then flip it the other way, reasons not to invest would be perhaps the market opportunity in our eyes is too small, or too difficult dynamics, or crowded for global category leadership, or there's team gaps that might need filling in our eyes to be really well placed to address that. And then it's going to be seeing them develop over time and seeing how they execute to build a greater view in our eyes on both the team and on the market, based on the way that initial traction can help us shape our view on that opportunity.
Okay. No, great. And let me build on that, because there is a question about how you assess the scalability potential of a startup, to fit your investment criteria. We did talk about traction. There are all kinds of definitions out there, but what's your definition?
Well, I guess when it comes to scalability criteria, again, it depends a bit on the product and the case. I mean, that's one reason why hardware is less in our scope, because there's a very different way to scale hardware than pure software. I think scalability, some opportunities you see that it's going to be very different market for market that they go into, based on a regulation or various dynamics, and that's going to be a hindrance to scale. Companies that are going to rely a lot on outbound B2B sales need to be very strong in scaling that part of their organization if they're going to be very strong at scaling their sales internationally and globally, whereas a company that is maybe more low touch in sales or consumer acquisition is going to have a very different way of driving scalability and their growth in a very digital way, and that's going to require a very different makeup of the team to be successful for that. So product, business model, the market dynamics, regulation, those all things can all reflect different levels of scalability. And then obviously the overall perception of the market size put some kind of ceiling on scale as well. So those things combined, I suppose.
Okay. So let me combine another set of questions. People are loving what you're saying. So the obvious next questions are, how do we reach you? Number one. Number two, and I think this is a typical question startups have, saying, do we need to sign NDAs with investors and VCs before we send financial information out? And particularly in your case, are you looking for just high-level information and teasers to begin with? Or do you want the entire spiel, on the first connect?
Yeah. So I can be reached at Emmet at J12Ventures.com. So that's the easiest way to. NDAs, I think, should be forgotten about completely. I don't think any investor will sign an NDA, at least not until doing some deep due diligence on some part of your IP, if that's what you work with. But requesting an NDA is kind of a bit of a red flag, I would say. So I'd avoid it at all costs in the early phases. Information for us, I think initially a pitch deck is the information that we need to understand what the opportunity is, where you're at, who's behind it, what you're aiming for, and then if you can create a concise deck with the ability to then entice a first meeting, then from there can have a deeper discussion, and from there look to understand more about the plan going forward, the financials, the product, and all aspects related.
Okay. And if there is a startup with a brand new market fit or a brand new business model, what's your first reaction? Is that a yay or a nay?
I mean, as said, I think we're most excited in creating new markets, shifting existing markets. I think those are some of the underlying market dynamics that best allow for category leadership and building huge companies. If you're addressing a market that doesn't have, that is exists, is very incumbent, doesn't have a lot of winds of change within it, it's very difficult to enter it and scale to some kind of leadership position. So I think new markets are or big shifts are obviously favorable. New business model, I think often that is as innovative as technology at the forefront. A lot of the most successful companies that we all know are more based on smart business modeling than on having an innovative technology addressing a market. So I think certainly if the innovation is based on business model, that can be fantastic.
Okay, great. Just in the interest of time, I think I'll round it off with this. It's a very interesting scenario that as much as we have startups pitching for investments, we now have investors pitching for suitable opportunities as well. So in Sweden, do you see it as a startups market or an investors market?
I think here as everywhere at the moment, I think it's a good time to be a founder. It's probably a founder's market. I think there's a lot of capital. There's a lot of great opportunities, but I think obviously a lot of capital is trying to invest in the same perceived best of those opportunities. So I think as much as ever in the last few years, founders have the position to choose who they want to invest in them, and I think that's something that founders should be careful to do and take time to do, because as I said, it's a long marriage. It's at least as important to just ensure that the person that you're going to work with in the fund or the angel investor or whatever is somebody that you have a good relationship with and good communication with, because that is far more important than what looks on paper to be great value add because of what they've done before or what they claim to know. You'll never tap into that if you don't have a strong working relationship. So take the opportunity in a founders market with a lot of capital to make sure that you partner with the investors that you like the most.
I'll jump in here a little bit for our audience. There's a lot of startup support available in Sweden for entrepreneurs. So before you become VC ready, it's good that you explore the first level of resources. There is Almi around, Coompanion is around, Sting has started open coaching. There are pre-accelerators like Founder Institute coming in. So all these resources are available, which make you more ready. And I love what, Emmet, that you just said, like rather than technology innovation, think for business model innovation. Look at market in a very different way and see how you can create a new opportunity. So explore the first level of resources in the market, because that'll strengthen your startup and the team and your resolve to move forward. Yeah.
And I think we can wrap it up.
Brilliant. Thank you, Vinod, for the questions. Emmet, thank you for being here for such an interesting, insightful 360 journey. So really appreciate your being here. Thank you to J12 Ventures. And thank you all in the community for joining. And we meet on 19th November with Anna Wickland from Google, and a lot more events are going to be announced in the next 2-3 weeks. So stay tuned. Have a very, very good evening. And I don't know if somebody skipped the lunch, go get it. Yeah.
Thanks, Emmet. Appreciate it.
Bye-bye. Thanks, guys. Bye.